Hello everyone, welcome to today's technical analysis lesson from ichimoku.co. Please remember to visit ichimoku.co for further technical analysis lessons and for the daily free market analysis videos, and to sign up to become a gold member for more substantial daily market analysis videos. Today we're going to look at trend lines and how we draw them correctly. Now, the important thing to ask about trend lines is, what are we trying to do with trend lines? What are we trying to describe? And the trend lines actually describe the rate of change of price over a period of time. And if we look at the axes of our charts, it's time on the x-axis and price on the y-axis. Price divided by time equals momentum, or rate of change, and that's exactly what a trend line does. A trend line just describes the rate at which that trend that it describes changes. It describes the momentum of that trend, nothing more, nothing less. It doesn't actually define the trend. Trend is defined by the peaks and troughs of the trend. And the good thing about using trend lines is that when we have a break of the trend line, or when we see price action accelerating away from the trend line, it suggests that either the trend is becoming, or the trend momentum is becoming less, and that the trend may be in danger of changing. Or if we're accelerating away from the trend line, say to the upside with an uptrend line, it's telling us that the momentum is actually moving faster than what the line was previously describing, and that the trend is accelerating. Now, very important, and this is important to remember, and a lot of people make this mistake, that a break of a trend line does not necessarily mean that we've had a break of a trend. Very, very important to remember, and a lot of people place too much importance on breaks of trend lines. Trend lines tell us something about momentum, and a break may warn of danger of a break of trend, but they don't mean that a trend has ended. Now, to construct a trend line, we actually need a valid trend in place, because after all, that's what a trend describes. A trend line describes a trend, and therefore we must have a valid trend. And we know from the previous lesson that a trend is defined to the upside as a series of higher peaks and higher troughs, or to the downside by a series of lower peaks and lower troughs. We also draw a trend line as a straight line, and I know that a lot of people know this, but it's very important to remember we don't have a curved line, we have a straight line. The other important thing with trend lines is that we use a log price scale. We don't use an arithmetic price scale. And when we draw a trend line, an uptrend line, we draw that uptrend line through the lows of an uptrend, or through the highs of a downtrend if it's a downtrend line. Now, here we have a valid trend in place. This is our first requirement. Here we have a series of higher peaks and higher troughs to the upside, or a series of lower peaks and lower troughs, and that's the minimum requirement. After all, if we don't have a trend, we can't draw a trend line. And for an uptrend here on the left hand side, we draw it through the troughs of an uptrend, and on the right hand side through the peaks of a downtrend. And that's because the trend to the upside actually starts with that first T, that trough. Here we have a trough, a peak, a higher trough, and a higher peak as we take out that previous peak. And that's why we draw an uptrend through the troughs, because the trend actually begins with that first trough, and the opposite for a downtrend line. A downtrend begins with that first peak. We have a peak, trough, lower peak, lower trough. It's confirmed when we form that lower trough, but this series actually begins with that peak, and that's why we draw a downtrend line through the peaks. So here we have a trend line drawn from that first trough. We have a trough, peak, higher trough, and once we take out that previous peak, we can draw an uptrend line. And that's the area marked there, that bar marked with the orange dotted line. Once we take out that area, we can draw an uptrend line. Now what we can do as price action accelerates away from that first trend line, and we can see that the trough here, HT2, is actually further away from that first trend line that we drew. And once we have another series of higher peaks and higher troughs, and that's at that point there, after the market takes out HP1, we can actually draw another trend line. And this fanning of the trend lines shows how price action is accelerating to the upside. To draw a downtrend line, we have to have a valid downtrend. Here we have a peak, a trough, a lower peak, a lower trough. And once the market takes out that trough, we have a lower trough in place, and that's the point, the first point that we can say that we have a downtrend in place, and we can then draw the line. Until we have that trough taken out, we can't draw a trend line, because we're not describing a trend, because a trend may not be in existence at that point. Once it's taken out, we have the qualification for a downtrend, and we can draw that line. Once again, as the market rallies towards that line and it fails to reach the line, and then price action comes down and takes at that LT1, that lower trough, we have establishment of a new trend that's been accelerating to the downside, and we can draw another line. And we're able to draw it at that point there. Once that lower trough is taken out, here we see the fanning process, and that fanning process to the downside, the angles becoming steeper to the downside, suggests that we have an acceleration of the trend to the downside. Now here's the common trap that a lot of players seem to fall into, and this is not a trend line, this green line here on these series of peaks and troughs, and it's because we don't actually have a valid trend in place. Here we have a trough, a peak, a higher trough, a lower peak, a higher trough, a lower peak. At no stage through this series do we have either a higher peak and a higher trough, or a lower peak and a lower trough. And if you see a line drawn like this, it's not a trend line. It's something of a support line for these troughs, but it's definitely not a trend line, and no one should be calling that a trend line. Now the other important thing to remember is that with a trend line, and a correct trend line, is that it should not cut through any bars, and that includes any price action prior to and after. Once that trend line is cut, then it's pretty much useless, and it suggests that the momentum of the trend has changed. But also, when we project that trend line backwards, it shouldn't cut price action. And here we have an example of a common mistake that's made. We have a line drawn through these troughs here, describing some sort of trending price action through here. This is not a trend line. This is actually what's called an internal trend line. And Edwards and McGee don't describe this as a trend line. They describe it as an internal trend line. It shouldn't actually be called a trend line. It should be called an internal trend line. And the reason is because trending price action actually began down here prior to drawing this trend line, and what we should be doing here is perhaps fanning some trend lines from this point of origination, or just after. But as I've mentioned, this is a common trap that people fall into. It's not a trend line, it's an internal trend line. Well, I hope that lesson has been useful. If you do have any questions about any of the lessons that I've been showing on the website from time to time, please don't hesitate to make contact. Please go to the website and look at the other lessons that are on there. Also take a look at the free daily video analysis, and join up as a gold member for more lessons and for more substantial daily video analysis.